You handled the company accounts. Why were company funds paying your personal credit card bills?
The person you are looking at is Natalie Brooks. According to federal allegations, more than $34 million in company money was drained from Koss Corporation over several years, almost without anyone noticing.
I know what it looks like, but I process hundreds of payments. Show me the records before you say I stole anything.
When the FBI arrived, every trail led back to the woman standing in front of them. The shocking part was that Natalie was not an ordinary employee. She was the finance vice president of that very company. And this is how one of America's most shocking corporate embezzlement cases was exposed. And before we begin, don't forget to subscribe to the channel to follow more cases like this. Natalie Brooks was a female finance executive who once worked at Koss Corporation, a headphone manufacturer based in Milwaukee, Wisconsin. According to case records, Natalie worked for Koss from 1992 to 2009. During that time, she held some of the most important roles in the company's finance department: principal accounting officer, secretary, and vice president of finance. She was not just an employee entering data or processing routine invoices. Natalie was among the people responsible for making sure company money was used for legitimate purposes, that outgoing payments had valid reasons, and that the financial reports released to the market reflected the true condition of the business. Koss was a public company. The numbers written in its books were not only used internally. They were reported to shareholders, investors, and regulators. That meant Natalie's position was built on an invisible but extremely important asset: trust. She had been inside that system for nearly 2 decades. She knew how payments were processed. She knew which bank accounts were used. She knew how transactions were recorded. And most importantly, she knew which weaknesses could turn an unusual transaction into a number that looked completely normal on a report. By December 2009, the image of a long-standing female finance executive had collapsed. Investigators found that Koss money had been diverted for years to pay personal credit cards, luxury goods, jewelry, fur items, furniture, travel, home improvements, and a 2007 Mercedes-Benz. Koss later determined that approximately $31.5 million had been misappropriated between fiscal year 2005 and December 2009. When the court sentenced Natalie, she was ordered to repay $34 million to the company. But this case was not shocking, only because of the amount of money. What made it chilling was that the person responsible for keeping the books honest had used those very books to hide the money disappearing from the company. Natalie Brooks began working at Koss Corporation in 1992. Over the years, she did not simply become a long-time employee. She moved into the center of the company's financial system. In a manufacturing business, the finance department tracks everything: which account sales money enters, which invoices are paid, which expenses require approval, whether bank balances match the general ledger, and eventually, which numbers the company reports to the outside world. Natalie understood that entire process. Working with her in the accounting department was Emily Carter, the changed name of the senior accountant in the case records. Emily handled especially sensitive tasks: recording journal entries, reconciling accounts receivable, reviewing bank statements, ordering cashier's checks, processing wire transfers, and checking daily bank balances. She reported directly to Natalie. That meant the two women were very close to the point where real money and accounting records met. In a strong control system, the person who requests a transfer, the person who approves it, the person who records this transaction, and the person who reconciles the account should be separated. That separation exists so no single person can take money and erase the trace of it at the same time. But according to records from the securities regulator, Koss's internal controls were not strong enough. Natalie had access to and influence over multiple steps in the same chain of transactions. Large sums of money could leave the company without being thoroughly reviewed by someone independent outside the accounting department. The company's accounting system was also outdated, lacked a strong enough audit trail, and did not prevent data from being changed after the accounting period had ended. That was the kind of environment where someone who understood the system from the inside could turn it into a tool for herself. No one looked at the female vice president of finance and thought she would become the greatest threat to the company's money. But for years, Natalie did not attack Koss from the outside. She was sitting inside their finance department. Koss sold products and received money from customers. The company used that money to pay suppliers, production costs, operating expenses, payroll, and other business obligations. When payments needed to be made, the company could use checks, bank transfers, or cashier's checks. Checks issued by a bank after the money had already been taken from the payer's account. On paper, every payment had to have a clear reason. If Koss sent money to a supplier, that transaction should be supported by invoices, documentation, and a business purpose. If a large sum of money was transferred out, an authorized person was supposed to review and approve it. Afterward, the accounting department had to record the transaction, so the balance in the books matched the balance in the bank. But here is the dangerous part. Real money can leave an account in minutes, while the story explaining where that money went sits in the hands of the person keeping the books. Imagine $100,000 being taken from a business account to pay a personal bill. If no one touched the books, the shortage would eventually appear. But if revenue was recorded lower, expenses were recorded higher, inventory was adjusted, accounts receivable were changed, or liabilities were reduced, the balance sheet could still look reasonable. The money was gone, but on the screen everything still balanced. And Natalie Brooks understood that very clearly. She did not only have the ability to move money out of Koss. According to investigation records, she also had the ability to direct the creation of accounting entries that made those money flows harder to detect. This was no longer just a simple theft. This was a case where the person holding the key also knew how to rewrite the records to prove the door had never been opened. According to official records, the misappropriation of Koss money began at least as early as 2004 and continued until December 2009. The early years of the scheme did not begin with a shocking $1 million wire transfer. The main method was cashier's checks issued with Koss money. A cashier's check is a legitimate financial tool. A company may use it to pay a supplier or make a large payment. But in this case, Koss money was put into cashier's checks that were not meant for production or business operations. They were used to pay Natalie's personal expenses. According to the plea, she caused more than 500 cashier's checks to be issued, with a total value of approximately $7.5 million. A large portion of that amount, about $10 million, was used to pay her personal American Express credit card account. Other payments were sent directly to high-end retailers such as Saks Fifth Avenue, Neiman Marcus, Marshall Fields, Zuckerman Jewelers, and Holtzman's Furs. In some transaction records, the payee names did not appear in a way that was immediately recognizable. Saks Fifth Avenue could appear as SFA Inc. Neiman Marcus could appear as NM. Inc. on a long and complicated list of corporate transactions. Abbreviations like those could look like ordinary vendors. But behind those letters were personal items, high-end clothing, handbags, shoes, jewelry, fur goods, and items with no connection to Koss's headphone business. What made it even more notable was that many of the payments were not small. Many cashiers' checks exceeded $5,000. Some exceeded $100,000, according to company policy described in SEC records. Invoice payments of $5,000 or more were supposed to be reviewed and approved by the CEO or CFO. Yet these fraudulent transactions continued passing through the system, one check, then another, then hundreds of checks leaving the company's account one after another. And each time no one stopped them, the limits of the scheme were pushed further. By 2008, the scheme no longer stopped at using cashier's checks for personal purchases. The money started moving faster, more directly, and in larger amounts. Natalie caused electronic wire transfers to be made from Koss's operating account directly to American Express to pay her personal credit card account. From 2008 to December 2009, more than $16 million was transferred this way. In the plea agreement, the specific number was recorded as 206 wire transfers. This is what made the case especially blatant. The money was not routed through a maze of shell companies overseas. It was not hidden in dozens of anonymous accounts that investigators had to trace for years. Koss money moved almost directly from the company's account to the personal credit card debt of its female vice president of finance. In October 2009 alone, SEC records state that there were 17 fraudulent wire transfers totaling $1,509,095 used to pay charges on Natalie's personal card. Just 2 of those transactions accounted for $1,018,595, more than $1 million in 2 transfers. During that same period, the money taken from Koss was transformed into an increasingly expensive personal lifestyle. According to FBI and SEC records, the money was used to buy high-end women's clothing, handbags, shoes, jewelry, fur goods, furniture, decorative items, china, expensive household goods, travel, and hotel expenses. Money was also used for improvements to her home in Mequon, Wisconsin, as well as a 2007 Mercedes-Benz. When the federal government began seeking forfeiture of assets, the list was not limited to cash. Authorities targeted the home in Mequon, the Mercedes-Benz, clothing, jewelry, artwork, household goods, high-end personal items in the home, property stored in 2 Milwaukee storage units, and even some items still located at local stores. Those items might once have looked like symbols of success. After December 2009, they became physical traces of a years-long misappropriation scheme. While Koss money continued flowing into Natalie's personal life, she remained the company's vice president of finance. She still stood inside the department responsible for explaining where the money was going. She was still one of the people trusted to make sure the numbers did not lie. And throughout that time, the numbers were being adjusted to hide her own conduct. A misappropriation scheme involving tens of millions of dollars should have triggered enormous warnings. Transfers of hundreds of thousands of dollars, cashier's checks going to luxury retailers, repeated American Express payments, differences in cash, revenue, and assets on the books. But what made this case especially frightening was that for years, Koss's internal system did not stop it. In the end, the warning sign that caused the scheme to collapse did not come from a sharp internal audit. It came from the recipient side. Around December 18, 2009, American Express informed Koss that money from the company's bank account was being used to pay charges on Natalie Brooks' personal credit card. It was a very simple question. Why was a headphone manufacturing company paying the personal bill of its female finance executive? From that moment on, one unusual transaction no longer stood alone. It pulled a series of other questions behind it. How many times had money been transferred? Who had the earlier cashier's checks actually paid? Why had the large payments not been stopped? Why had the financial statements not clearly shown that money was disappearing? When Koss began reviewing accounts and documents, transactions that had been sitting silently inside the system suddenly joined together into a complete story. The company's account had been used to fund the personal spending of the very person responsible for finance, and the matter was not limited to a few credit card bills. It led straight into the accounting books. When investigators began reconstructing the flow of money, the financial evidence almost connected itself. Bank statements showed money leaving Koss accounts. American Express records showed that those funds were used to pay Natalie's personal obligations. Cashier's checks showed millions of additional dollars being sent to luxury retailers. Assets in the home, in storage units, and at stores showed how the money had been turned into specific items. But if the investigation had stopped there, this would have been a major embezzlement case. What turned it into one of Wisconsin's most stunning financial fraud cases was the way the company's books had been manipulated. According to SEC records, Natalie and Emily Carter used false accounting entries to hide the money taken from Koss. When actual cash decreased, the books could be adjusted so the shortage would not appear in an obvious way. Revenue was reduced, making the company look as if it had never received part of the cash flow. Expenses and cost of goods sold were increased, making the missing money look like business costs. Assets were increased or liabilities were reduced, allowing the balance sheet to continue looking reasonable. Cash, accounts receivable, and inventory were manipulated to cover the gaps created by the personal transfers. In the first 2 quarters of fiscal year 2010, SEC records alleged that the false entries overstated Koss's assets and understated its liabilities by more than $7.5 million. From fiscal year 2004 through the second quarter of fiscal year 2010, improper adjustments to the income statement exceeded $9.5 million. And during the review of documents, investigators found a particularly striking detail: files referred to in the records as the Red Book. According to the SEC, Emily maintained 1 or more files containing false entries used to adjust Koss's numbers. Some items contained handwriting and the mark "entered," showing that these were not merely preparatory notes. They had been entered into the company's accounting system. In April 2009, one entry reduced revenue by $200,000 and reduced cash by the same amount. On the books, the transaction made it appear as though the company had never had that revenue or cash flow. Also in April 2009, another entry increased cash by $1.5 million, while reducing accounts receivable by $700,000 and inventory by $800,000. The numbers may have added up on paper, but they distorted the actual financial reality of the business. In July 2008, records showed an entry reducing cash by $750,000, while also adjusting inventory, liabilities, and revenue to hide the effect of money that had been taken. In August 2009, another entry increased accounts receivable by $1 million, increased inventory by $1 million, and reduced an intermediary account by $2 million. $2 million was shifted on paper to cover a simple reality. The real money was no longer where it was supposed to be. In addition to the Red Book, SEC records also mentioned colored files called rainbow files. These files contained more than 100 improper transactions related to Koss's books. One technique used was called DC wipe. In substance, it involved erasing the trace of a real transaction by recording debits and credits across multiple accounts, making revenue and customer money appear as if they had never existed. The SEC also stated that from fiscal year 2006 through the second quarter of fiscal year 2010, more than $1.8 million in sales from Koss's internet and retail store channels had not been properly recorded. Customers had bought products, money had been paid. But inside the accounting system, part of the trace of that cash flow had been erased or distorted. The investigation also exposed serious weaknesses in Koss's internal controls. Natalie could participate in many steps of the financial process, accessing checks, influencing transfers, participating in bank reconciliations, and working with the general ledger. Transactions outside the normal payment process were not adequately monitored. There was not strong enough independent review of large sums of money leaving the company. The accounting system was old, lacked a sufficient audit trail, and did not close accounting periods in a way that could prevent later changes. One number showed how serious the case was. In fiscal year 2009, Natalie took approximately $8.5 million from Koss. That same year, the company reported total revenue of about $41.7 million and ending retained earnings of about $17 million. In 1 year alone, the money taken amounted to more than half of the retained earnings the company reported. This was not a small loss buried inside a massive corporation. This was a huge stream of money disappearing right in front of the people responsible for protecting the company. But it had been wrapped in journal entries, documents, and numbers that appeared to make sense. On December 21, 2009, only a few days after the warning from American Express, Koss requested that NASDAQ halt trading in the company's stock because it had discovered unauthorized financial transactions. That same day, the FBI interviewed Natalie Brooks. At that point, she was no longer standing before coworkers as a longtime female vice president of finance. She had to face transactions recorded with dates, amounts, and recipient accounts. Koss money had paid her personal American Express bills. Company cashiers' checks had gone to high-end stores. Luxury assets had appeared in her home and storage units. And accounting entries had been used to hide the impact of the missing money. According to records, Natalie admitted that she had used company money to pay personal expenses, including credit card bills. She also admitted that she had falsified accounting records to conceal the misappropriation. During the FBI interview, she explained that she had a problem with compulsive shopping. But in front of investigators, the issue was no longer just an uncontrolled shopping habit. It was more than 500 cashier's checks. It was 206 wire transfers. It was tens of millions of dollars in company money. It was years of altered books. It was a scheme that could only survive for so long because the person carrying it out held a trusted position inside the financial system. At the end of the FBI process, Natalie was arrested. On December 23, 2009, Koss terminated her employment. On December 24, 2009, the company filed a report with the SEC stating that previously issued financial statements for the years ending June 30, 2006, 2007, 2008, 2009, as well as the quarterly report ending September 30, 2009, could no longer be relied upon because unauthorized transactions had been discovered. A public company had to openly admit that the reports once representing its financial condition had been damaged from the inside by the very woman once entrusted to protect them. On January 20, 2010, Natalie Brooks was federally charged with 6 counts of wire fraud. Each count was tied to a specific transaction in which money from Koss accounts was transferred to American Express to pay Natalie's personal bills. At the time of the indictment, prosecutors determined that she had taken more than $31 million from Koss to fund personal purchases and expenses. On July 27, 2010, Natalie pleaded guilty to all 6 counts. In the plea agreement, she admitted that she had caused more than 500 cashier's checks to be issued, totaling approximately $17.5 million. She also admitted that she had made 206 wire transfers, totaling more than $16 million, from Koss accounts to American Express to pay her personal card. Not only that, she admitted that she had directed the creation of false accounting entries to make personal spending appear like legitimate company transactions. On November 17, 2010, the United States District Court for the Eastern District of Wisconsin sentenced her. Natalie Brooks was sentenced to 132 months in prison, equal to 11 years, 3 years of supervised release after prison, restitution of $34 million to Koss Corporation. Later, in the civil case brought by the SEC, Natalie was permanently barred from violating federal securities laws related to fraud and books and records requirements. She was also barred from serving as a director or officer of a public company. As for Emily Carter, SEC records did not describe her as the person who spent tens of millions of dollars on a luxury lifestyle like Natalie. However, the SEC alleged that Emily helped conceal the money flow by processing wire transfers, ordering cashier's checks, and recording false journal entries in the accounting system. In the related civil case, Emily accepted the court's judgment without admitting or denying the allegations. She was ordered to pay $27,600, including disgorgement and prejudgment interest, along with a $40,000 civil penalty. The documents once used to conceal the transactions, the red book, the colored files, the adjusting entries, ultimately became part of the picture showing how the system had been manipulated. But the sentence could not immediately repair what had been broken. After the case was discovered, Koss had to review and restate its financial reports. On June 30, 2010, the company filed an amended report determining that approximately $31.5 million had been misappropriated from fiscal year 2005 through December 2009. The numbers showed that the scheme accelerated rapidly in its final years. In fiscal year 2008, Koss reported unauthorized transactions of $5,999,900. In fiscal year 2009, that number rose to $498,434. And from July 1, 2009, until the case was discovered in December of that year, the amount of unauthorized transactions reached $10,286,988. That meant that in less than the final half year, Natalie took more money than in any full fiscal year previously disclosed in the adjustment table. The scheme did not stop itself. It grew faster after every successful attempt. When no one detected the first check, she continued with more checks. When the American Express payments were not stopped, she transferred larger amounts. When the books continued covering the gaps, false entries became the layer of camouflage over an increasingly enormous flow of money. After the case, the SECs also brought a civil action involving Koss Corporation and the company's CEO over issues related to false financial reporting and inadequate internal controls. Koss and the related executive resolved the matter without admitting or denying the allegations. For Koss, the damage was not only the $31.5 million identified as lost or the $34 million restitution ordered by the court. The company also had to face the fact that years of its financial statements could no longer be relied upon. It had to explain to the market that a senior figure inside its financial operation had used company accounts for personal spending, and that the internal books had failed to stop it. The case also raised a question much larger than Natalie Brooks herself. Who can a company trust if the person responsible for controlling cash flow is the one who understands best how to move money out without being detected? Because in this case, there was no stranger breaking into the office at night. No safe was forced open. No computer was hacked from the outside. Money left the company through the very legitimate tools businesses use every day: bank checks, wire transfers, accounting documents, and journal entries. The person behind them did not need to bypass the security system. She was already inside it. Natalie Brooks did not take money from a company that was unfamiliar to her. She took money from the place that had given her position, authority, and trust for nearly 2 decades. She did not only know where Koss's money was, she also knew what the books would say when that money disappeared. More than 500 cashier's checks, 206 wire transfers, approximately $31.5 million identified by the company as misappropriated, $34 million in restitution, and 132 months in prison for the woman who had once been responsible for making sure Koss's numbers were honest. For years, every luxury item, every American Express bill, and every adjusting entry was one small piece of the same story. A story about how trust can be used as a key, about how a weak system can remain silent in the face of hundreds of unusual transactions, and about how the person keeping the books tried to turn tens of millions of stolen dollars into numbers that looked as if nothing was wrong. But money can be transferred, documents can be rewritten, books can be distorted for years. Yet in the end, the money trail always leads back to the person who took it.